Welcome to Doctorates of the Absurd, your provider of belief on demand.
And welcome back to the deep dive. Today we're taking on a concept that is steeped in modern anxiety, and we're going to try and strip it down to its historical and conceptual roots.
We are undertaking what honestly feels like an act of economic heresy today.
It really does.
We're cracking open the one idea that has been labeled public enemy number one by pretty much every major central bank for, the better part of 5 decades now?
At least. We're talking about deflation.
That sustained, chilling decline in the aggregate price level.
Yeah, and the modern consensus on this is, it's crystal clear. Deflation is an unmitigated catastrophe. Full stop.
It's a spiral into depression, stagnation, unemployment, all of it. It's the boogeyman that keeps policymakers up at night.
But we've sourced a really fascinating deep analysis. It's a working paper from the Bank for International Settlements, the BIS, and it just fundamentally challenges that whole premise.
Yeah. And the hook from this research is so simple, but it clashes with basically everything we think we know about economics. It asks, what if the biggest fear in economics, the fear of falling prices, is actually the sign of a healthy, rapidly advancing economy?
I mean, just think about the world you live in right now.
Yeah.
We have sources pointing to these massive productivity shocks from new technology.
Like AI?
Exactly, like AI. We're seeing estimates that the cost of running certain AI models has just plummeted. Some say prices have fallen by 900 times.
900.
Which makes some of this complex computing cheaper than, like, a bottle of mineral water.
It's incredible. Or you look at the energy sector, right? This idea of value deflation in wind and solar.
Yeah, where the tech gets so good and the scale gets so big that the cost of producing energy just keeps falling year after year.
And these aren't just temporary sales. This is a permanent, structural decrease in the cost of providing something essential.
And that's the point. These are pure, unambiguous welfare gains for everyone. When the cost of getting something useful, whether it's computation or energy, drops by orders of magnitude, your real purchasing power just explodes.
That is, by definition, success. That's economic progress.
It is.
So our mission today is to really deconstruct this tension. Why do central banks see these incredible advances that naturally create lower prices and still treat any price decline as a catastrophe?
Why are they so intent on offsetting what should be a blessing with, manufactured inflation, always targeting that 2% number as if it's some kind of sacred text?
Yeah, and we're going to dive into the nuance that history gives us, because for a huge chunk of history, from the Civil War to World War I, price levels went down just as often as they went up.
And crucially, those periods of falling prices were often associated with really robust, dynamic, real GDP growth.
So there's the core tension, that's the existential itch. The conflict between achieving real welfare, gains making life genuinely cheaper for all of us, and maintaining nominal financial stability.
Because that stability is threatened by that toxic interaction of falling prices and high debt.
Debt deflation.
That's the mechanism. That's what this BIS study is trying to untangle. How do we structure policy to get all the fantastic benefits of a high-productivity world where things get cheaper, without triggering the financial instability that turns a boom into a bust?
And the core insight, the framework we're going to use for this entire deep dive, is that deflation is not monolithic. It's not one thing.
It's an umbrella term, and it hides wildly different economic realities.
So to understand the past, and maybe more importantly, to prepare for a future that's going to be shaped by these massive productivity shocks from things like AI, we have to use the study's central organizing principle.
We have to learn to distinguish between the good, the bad, and the ugly types of deflation.
That framework is going to be your toolkit for the next hour.
Let's get into it.
Okay, let's unpack this, and let's start with the positive side of falling prices. The idea that this can actually be a sign of success, not, impending doom. This is the good deflation.
Exactly. And we have to define it very clearly. Good deflation is a sustained decline in the aggregate price level that is specifically associated with productivity-driven economic growth.
So prices are falling because we're getting radically better at making things. Cheaper, faster, more efficient. Not because demand has just vanished off a cliff.
Precisely. And this isn't some, theoretical fantasy. The historical record is full of it.
And the study gives a prime example.
It does. The most robust example is the period from 1873 to 1896. This was the absolute peak of what we call the Second Industrial or Mechanical Revolution.
An era that just completely transformed the world.
It really did. You had breakthroughs like the mass production of steel with the Bessemer process, the widespread electrification of industry, and maybe most importantly for commerce, the proliferation of railroads across entire continents.
And in economic terms, what did that actually mean?
It meant the cost of moving goods, which is kind of the fundamental friction in a global economy, just plummeted.
Suddenly, grain from the American Midwest could compete with grain grown in Europe.
Right. And steel could be made faster and cheaper than anyone had ever imagined.
And the data shows this perfectly.
It really does. During that entire 23-year period, prices across the industrializing world fell by about 2% per year, consistently.
But here's the kicker, the really counterintuitive point.
This persistent fall in prices was accompanied by equally persistent, strong, real output expansion. GDP was growing at 2 to 3% per year.
So people were getting richer in real terms, and their money was literally gaining purchasing power every single year.
Exactly. And that historical example translates perfectly to what we're seeing today with technology.
The sources we have discussing AI, for instance.
Right. If a new technology like AI drops computation costs by 900 times, that's the modern version of the railroad slashing transport costs.
It's not an economic disaster. It's wealth creation on a massive scale.
It's a pure structural welfare gain. When we talk about wind and solar value deflation, it's the same logic at play.
Technology and investment have lowered the marginal cost of producing clean energy so much that the market price actually falls even further.
So the policy question really shouldn't be, how do we fight this falling price? It should be, how do we manage this transition to get all the benefits?
So the logic here is pretty simple then. If the rate of technological progress outpaces the rate of money supply growth, prices fall.
And as long as employment and output are strong, everyone gets objectively richer in real terms because their money buys more stuff.
That's the definition of good deflation.
That's it. But then, of course, we have to confront the spectrum of pain.
Which leads us to the bad and the ugly deflation, the categories that understandably dominate how policymakers think.
Let's start with bad deflation. This seems to be more cyclical, maybe policy-induced, but it doesn't have that systemic collapse of the 1930s.
Right. So bad deflation is characterized by a price decline that corresponds with a pretty significant but still manageable contraction in economic activity.
And the key historical example they point to is the period right after World War I, specifically 1919 to 1921.
I mean, that was brutal, though. U.S. GDP fell by a staggering 18% in just 2 years. That sounds pretty apocalyptic.
It was incredibly severe, no doubt.
Yeah.
But we have to look at the cause. This contraction and the fall in prices was largely engineered.
On purpose.
On purpose. It was driven by extremely tight monetary policy. The authorities, especially the Fed and the Bank of England, were desperate to reverse wartime inflation.
They wanted to restore the pre-war gold parity.
Exactly. So they intentionally tightened financial conditions to force prices and output down to meet that nominal anchor commitment. It was policy-induced pain.
For the sake of restoring the gold standard's credibility, they were willing to swallow a severe, sharp recession to prove they were committed to a fixed price level.
And critically, while it was severe, this episode was still, largely in line with earlier sharp cyclical contractions. It was painful, but it was correction. It wasn't the death spiral of the 1930s.
Okay, so that spiral is reserved for the ugly deflation. This is the one, the outlier that has fundamentally shaped, and you could argue warped, all of modern economic policy.
The Great Contraction, 1929 to 1933.
This one is in a class all its own, sui generis, as the people says.
It really is. It wasn't just a recession. It was a complete systemic collapse. It was characterized by this drastic decline in both output and prices that just fed back on itself.
What were the numbers?
U.S. real output declined by 7.6% per year, while prices fell by 6.8% per year. But here's what made it so unique.
Go on.
The decline in aggregate demand went disproportionately into output collapsing, rather than just prices falling to clear the market. This reflected these new structural rigidities, especially sticky wages, that just weren't as prevalent in earlier downturns.
So if the 1921 contraction was policy-induced and the 1870s deflation was productivity-induced, what was the specific, unique mechanism that turned a stock market crash in 1929 into a full-blown ugly depression?
The consensus, and we'll get into this more, attributes it almost entirely to a series of unchecked, self-fulfilling banking panics that started in 1930 in the U.S.
So it was a financial system.
It was the complete failure of the financial system, which then interacted violently with the collapsing prices. It led to this cascade of lost confidence, massive bankruptcies, and debt crises that just choked off all credit.
Turning a deep recession into a devastating systemic contraction.
Exactly. And this single ugly outlier seems to color all current policy. The fear of doing a 1930s causes central banks to, overreact to potentially benign price drops today.
And the study actually has the statistical proof to back that up, right? To show that the Great Contraction shouldn't be the default assumption.
It does. When the researchers looked at all persistent deflationary episodes globally, but they excluded that unique Great Contraction period,
What did they find?
they found that deflations associated with severe output contractions were remarkably rare.
So what were the typical numbers?
The mean duration of a persistent deflation was about 5.4 years, but the accompanying change in output was highly variable. Sometimes it was positive, sometimes negative.
Which just reinforces the core conclusion. Not all deflations are alike.
Not at all. The vast majority are either benign or just simple cyclical adjustments. They're not spirals into ruin.
But even if we accept that, even if good deflation is the norm, this study doesn't ignore the fact that the 1873-1896 era, the golden age of productivity, still had massive political turmoil in the U.S.
Right.
Why did all that prosperity cause so much political agitation?
That really comes down to the role of unanticipated deflation. If a broad multi-year price decline isn't fully expected when you sign a contract, it can generate these really significant, painful redistributive losses, even if the overall economy is doing great.
This is the famous debt deflation mechanism that the economist Irving Fisher first detailed.
And it's so important to break this down because this pain is what fueled the politics of the era.
Give us an example.
Okay, imagine you're a farmer in 1880. You take out a $5,000 mortgage on your land, payable over 20 years.
Okay.
When you take out that loan, corn sells for $1 a bushel. So to make your yearly payment, you need to sell a certain amount of corn.
Let's say the payment is $500. You need to sell 500 bushels of corn. Simple enough.
Exactly. But now, because of that railroad productivity boom, prices are falling by 2% every year. So by 1890, corn is only selling for, say, 50 cents a bushel.
Uh-oh.
Your debt is still nominally $5,000. But now, to make that same $500 payment, you have to sell 1,000 bushels of corn.
Twice as much. The real value of your debt has just skyrocketed relative to your income.
You're paying off old debts with increasingly expensive dollars, even though the whole economy is growing. It's a disaster for any leveraged sector.
And it was a disaster for the debtors, farmers, new industries, workers whose nominal wages didn't keep up.
Which generated incredible political resentment.
And the response in the U.S. was intense. This is the era that gave rise to the populist movement, the free silver movement.
Championed by William Jennings Bryan. They were demanding monetary expansion, specifically, using silver to expand the money supply, to intentionally inflate prices and reduce the real burden of all that debt.
So the big takeaway here is that the distributional cost of unexpected price volatility is a huge historical and political reason why policymakers became so afraid of any price volatility.
Regardless of the source, it didn't matter if it was good productivity or an ugly demand collapse. The pain for debtors was real, and that's what separates the neat academic theory from the messy political reality of managing a leveraged economy. So we connect this detailed history to the bigger picture. The difference between a good deflation and an ugly one really boils down to two key factors.
And they're interconnected.
They are. It gets down to the nature of the nominal anchor and the health of the banking system.
Let's start with the anchor, because that's what dictates everyone's expectations. For centuries, the global system had a very different mechanism than what we have today.
That was the classical gold standard, which pretty much dominated global finance before 1914. It served as a really strong, credible, nominal anchor.
Why? What was the mechanism?
Because prices were tied directly to gold. In the long run, the price level was tethered to the marginal cost of producing gold.
And why does that prevent the kind of scary, expectations-driven spiral we worry about today?
Because it meant that prices were mean reverting.
Meaning they would always tend to snap back to an average.
Exactly. If a productivity shock from railroads caused prices to fall by 2% for a decade, everyone in the market, lenders, borrowers, everyone knew that eventually market forces would have to bring prices back up toward the parity set by the gold standard.
So if prices fell way below that parity, speculators would bet that the price level had to rise eventually. It was like a rubber band pulling prices back to the center.
That's a perfect analogy. Long-run price uncertainty was low, even though short-term volatility could be pretty high. And that long-run anchor prevented the kind of fear-driven deflationary spiral that we imagine today.
Where everyone expects prices to fall forever, so they stop spending, demand collapses, and it just accelerates.
The gold standard provided a credible mechanism to stop that expectation in its tracks.
But wait, isn't that exact mechanism the reason it eventually collapsed? Didn't that mean reversion often require politically impossible decisions?
Like intentionally engineering a recession like they did in 1921 just to re-anchor the price level.
Exactly.
That's the crucial counter-argument. It required sacrifice, absolutely. The key is that the system only worked because the commitment was credible, even when it was painful.
And the study suggests there's a modern framework that tries to get that same stability without needing a physical commodity.
Yes, it's called price level targeting, or PLT.
Okay, explain PLT for us. How is it different from what we do now?
Well, today we do inflation targeting, or IT. That targets the rate of change.
Right.
So the goal is 2% inflation this year.
And if inflation is only 1%, they miss, but then they just move on. They aim for 2% again next year.
Right. They have amnesia, as economists say. PLT, on the other hand, targets a specific price path.
Yeah.
So if the central bank undershoots and prices fall below that target path,
They have to make it up.
they have to commit to an aggressive expansionary policy later to make up the miss and get back to the original path.
So if prices fall because of a good productivity shock, the market knows the central bank will have to allow for higher inflation later on to get back on track.
And that expectation alone should temper the fear of indefinite deflation. It anchors long-run expectations, just like the gold standard did. And that's one of the paper's main policy recommendations from history.
If you want the flexibility to absorb good deflation, you need a robust, credible, long-run anchor like PLT.
Right. Now let's pivot to the second and honestly more dangerous factor.
Yeah.
The health of the banking system.
This is the hidden mechanism. You said the statistical finding here really dictates whether deflation turns ugly.
It is the defining differentiator. This should be the central lesson for every policymaker. Deflation is primarily ugly when it interacts with existing financial fragility.
Meaning too much leverage, bad loans, hidden problems on the bank's balance sheets.
All of it. And the data the BIS researchers put together is just staggering when they classify these deflationary episodes.
Okay, give us those numbers again because they're worth sitting with.
When their data shows that no banking crisis exists, the probability of deflation being good, that is, associated with strong or moderate output growth, is 93%.
93%.
93.
That is an immense number. It tells us that good productivity-driven deflation is the overwhelming default outcome, as long as the financial plumbing is sound.
Deflation itself isn't the problem. It's the weakness in the financial system that's the tinderbox.
So what happens when a banking crisis does exist?
Then the probability of ugly deflation, where the contraction cascades into a full-blown financial collapse, rises significantly to 28%.
Wow.
The crisis variable is overwhelmingly the most powerful predictor of disaster. And this flips the whole narrative on its head. Deflation is often a symptom of deeper financial problems, not the cause of ruin.
Let's walk through why the financial system is the weak link. When prices start to fall, what happens inside the banks?
Well, if the system is riddled with too much debt, the value of the collateral that backs that debt, real estate, corporate assets, it starts to fall faster than the debt itself.
And that's where the debt deflation spiral really takes hold.
Exactly. Banks see their collateral value evaporating, so they call in loans or they just stop lending entirely. Credit gets choked off.
Which means the monetary transmission mechanism is broken.
It's completely impaired. Even if the central bank tries to cut rates or inject money, the banks are too scared or too busy trying to fix their own balance sheets to actually pass that money through to the real economy.
So the recession becomes a full-blown contraction because confidence breaks and the credit pipeline freezes solid.
Which means the lesson isn't to fight productivity. The lesson is that robust financial and prudential frameworks, controls on leverage, stress testing, making sure banks are well capitalized, that's the true defense against deflation turning ugly.
Monetary policy alone can't fix a problem that's rooted in a dysfunctional financial system.
Exactly. And we can see this so vividly by looking at two more recent but very different case studies, Japan and Hong Kong.
Japan, starting in the 1990s, is the modern poster child for deflationary stagnation.
A clear case of bad deflation. Japan had this persistent mild deflation and stagnant activity. But the underlying cause, according to the sources, wasn't a failure of monetary policy to provide liquidity.
It was the banks.
It was deep-seated banking sector problems. They had a massive hidden pile of non-performing loans left over from their 1980s bubble.
And the government and the Bank of Japan just couldn't force those insolvent banks to clean up their balance sheets.
Right. They became what we call zombie banks. They were unable to lend productively, even when interest rates were at zero. Monetary expansion alone couldn't fix that broken financial system. The failure was prudential, not monetary.
Okay, now contrast that with Hong Kong's SAR, which had a severe, persistent deflation after the 1997 Asian financial crisis.
Hong Kong is a fascinating study in what the paper calls the cost of commitment. Deflation there was brutal, driven by a huge wealth shock when property values crashed.
But they had a rigid commitment to a hard nominal anchor.
A currency board. Their dollar was pegged to the US dollar. They couldn't devalue their currency or just print money to inflate away the debt.
So they chose to maintain the peg.
And their choice to stick to that hard anchor required a really painful, long domestic price and wage adjustment. Wages and prices had to fall internally to adjust to the high currency value.
And what's the lesson from that?
It shows that if a country maintains commitment to an anchor, sometimes enduring the deflationary adjustment can be less costly in the long run than abandoning the commitment and sacrificing your credibility.
And crucially, Hong Kong's financial sector, while under intense pressure, stayed resilient. The banking crisis variable was low, which prevented the ugly outcome, even if the bad outcome involved real pain. Here's where it gets really interesting, because now we're moving from history to the toolbox that central bankers use today.
Right.
They've basically revealed their preference. They want to operate in what the paper calls Zone 3, a low inflation zone, say between 0 and 4%.
And the whole reason they aim for 2% is to give themselves a cushion.
A cushion to avoid running into the floor where all this potential good deflation lurks.
That floor is the infamous zero lower bound, the ZLB.
Okay, let's define the ZLB and explain why it absolutely terrifies central bankers.
So the ZLB is the point where the short-term nominal interest rate, the one central banks control, gets very close to zero.
And the terror comes from physical cash.
Exactly, because physical cash always offers a nominal interest rate of 0%. So if a central bank tried to set rates at, say, -1%,
everyone would just pull their money out of the bank and hold it as cash. The policy would be totally ineffective.
which is why that 2% inflation target is seen as a buffer. If the economy needs a -3% real interest rate to get going during a recession, and inflation is at 2%,
The central bank can set the nominal rate at -1%, which is only marginally constrained by the ZLB.
precisely, hitting the ZLB severely limits their main tool interest rate cuts for stimulating demand. It complicates everything and risks a liquidity trap where monetary policy just becomes paralyzed.
But the sources here suggest that even at the ZLB, central banks are not powerless. The argument is that the focus has to shift entirely to a different strategy,
It has to shift to monetary aggregates, targeting, or MAT.
targeting the money supply itself, not the price of money.
Right. The key insight is that when interest rates are stuck at zero, they stop being a reliable guide for anything. And this isn't just a theory. There's compelling historical evidence.
What's the evidence?
They looked at two U.S. recessions, 1937-38 and 1948-49. In both of those periods, interest rates were extremely low, basically at zero.
So if you were just looking at interest rates, you'd think policy was highly accommodative, but the economy was still sluggish.
But what the sources show is that movements in the real monetary base, so the inflation-adjusted supply of actual money, tracked the real economy much better than real interest rates did.
The quantity of money being pumped out was a better indicator of the recovery than the interest rate was.
By far. And this strongly supports the idea that the MAT strategy is superior when you're in a deep deflation or near the ZLB. If you can't cut rates, you can still boost the economy by massively, incredibly expanding the money supply.
This is basically what quantitative easing tries to do, right? Though maybe not always communicated that well.
That's the idea. And this historical finding feeds directly into what the BIS research calls the zonal view of policy.
Okay, explain the zonal view. The idea that you can't use one tool for every situation.
They frame it across 5 zones of price movement. And the argument is that MAC targeting the money supply is best suited for the extremes. Deep deflation, which is zone 5, and high inflation, zone 1.
Why the extremes?
Because in those zones, prices are volatile, but the sheer quantity of money being injected or withdrawn provides a necessary, reliable signal.
And the normal interest rate targeting we use today.
That works fine in the moderate zones, zones 2 and 3, where inflation is low, but rates are still comfortably positive.
But in those critical transition zones where you're close to zero,
That's where you need a mixed contingent strategy. Policymakers have to be ready to switch instruments transparently when interest rates are no longer doing the job.
Okay, now let's talk about a major psychological bias that's raised in the paper, the asymmetry trap.
Right.
We often hear that central banks react way more aggressively to a deflation scare than they do to an upside inflation risk of the same size. Why is that bias so powerful?
Well, the bias is built on the assumption that the costs of deflation are just inherently asymmetric, that falling prices are fundamentally more debilitating than rising prices,
And this is rooted in the trauma of the Great Contraction.
and the fear of hitting the ZLB. So avoiding deflation at all costs is seen as the optimal strategy, even if it means you risk slightly higher inflation down the road.
But the statistical evidence from the study actually undermines this deeply held belief.
It does, at least outside the specific context of a financial crisis. They ran statistical tests on historical data, looking at how persistent deflationary periods were compared to inflationary ones. They found that the persistence of deflation was often symmetric, or surprisingly, even less persistent than inflation. If prices started falling, they often snapped back to trend faster than if they started rising.
Which suggests that in a structurally sound economy, the market is actually much better at correcting deflationary pressures than policymakers give it credit for.
And this leads directly to the risk of inducing an upward inflation bias in the economy.
How?
By routinely overreacting to deflation scares, by fighting these benign price drops, central banks keep monetary policy too accommodative for too long during recoveries.
They end up sacrificing the long-term benefits of low inflation just for an unnecessary short-term safety net against a deflationary spiral that probably wasn't going to happen anyway.
Exactly. They bake in a higher baseline inflation rate than necessary. And in doing so, they are constantly fighting against the potential real welfare gains from those productivity shocks.
So they might be fighting good scares where prices are falling because technology is getting better, and in the process, they're actually hurting the real purchasing power of the average person.
That's the trap. So this whole historical and statistical review forces us to ask a really important question, and this is for you, the listener, trying to make sense of the economic future.
The question is, how should a central bank design a robust framework for a world that's going to be dominated by these powerful structural productivity shocks and perpetually low underlying inflation?
Given the rise of AI, renewables, all of it.
And the first strategy has to be a fundamental rethinking of the inflation target itself. If the world is structurally deflationary because tech makes everything cheaper, why are we so obsessed with 2%?
Well, economists have debated this for a long time. Back in the late 1960s, Milton Friedman proposed his optimum quantity of money rule.
And what did that rule suggest?
It suggested that the optimal inflation rate might actually be a moderate deflation, one that matches the long-run growth rate of the real economy.
Why moderate deflation? What's the logic there?
Because having zero interest on physical cash is effectively a tax on holding money. Right? If you have moderate deflation, the real return on holding cash becomes positive. It makes holding money more efficient.
And some models put that optimal deflation rate at what, -3%?
Something like that. So we might be actively working against economic efficiency by aiming for positive 2% inflation, which is a significant tax on holding cash.
And on top of that, we need to look at the data we're even using today. The Consumer Price Index, the CPI, is widely acknowledged to have an upward statistical bias.
It does. It's often estimated to be between 0.5% and 1%.
And where does that bias come from?
It comes from things the index doesn't capture well, like consumers substituting cheaper goods when prices rise, or the fact that it doesn't fully account for the massive increase in quality or utility of a product over time. Your smartphone today is not the same as a smartphone from 10 years ago.
This is a huge point. If a central bank targets, say, 1.5% measured inflation, they might actually be operating at 0.5% real inflation, or maybe even slight deflation relative to the actual cost of living.
That is the powerful implication. If actual deflation coincides with a positive measured inflation rate of below 1%, it suggests central banks are already much closer to this theoretically optimal rate than they realize.
Which means the costs we're bearing from unnecessarily targeting 2%, like fighting off those technological gains, might be completely unnecessary.
They might be very high. So the second strategy then involves refining the policy tools to get rid of that ZLB problem without sacrificing the gains of low prices.
This means adopting those mixed or contingent rules we talked about.
The historical evidence from the 30s and 40s is just undeniable. When interest rates get near zero, relying only on interest rate rules is incredibly perilous.
So central banks need a pre-committed, transparent strategy to switch gears.
They should be prepared to switch from interest rate targeting to monetary aggregate targeting when rates get too low. That dual approach gives you the robustness you need.
And the final, and maybe the most important piece of the framework is structural integrity. This feels like the ultimate lesson from all the
It
sources.
is. Sound fiscal and prudential frameworks are what's required to prevent a bad deflation from ever escalating into an ugly one.
So the best defense isn't actually aggressive monetary policy.
It's a well-capitalized, well-regulated banking system.
Exactly. If the financial system is resilient, if it's not overloaded with leverage and hidden problems, then policymakers have the room to respond to these big supply shocks appropriately.
You can welcome the massive benefits of a productivity boom like the one AI promises, without the existential fear that it's going to cause a financial collapse.
So the key lesson is that monetary policy can eliminate deflation, but its strategy has to be robust, transparent, and above all, credible.
If central banks are credible, the way the gold standard was for decades, then people expect any price deviation to be reversed. It anchors expectations and makes policy infinitely more effective.
And that brings us right back to the technological imperative.
It does. The goal of policy shouldn't be to blindly maintain a positive number on a spreadsheet. That's sacrificing real wealth for nominal safety.
The goal has to be to welcome good, productivity-driven deflation, those huge welfare gains that make things cheaper, while fiercely guarding financial stability through smart rules. The sources show us the path to achieving both. This deep dive has done, I think, a lot more than just challenge a consensus. It's fundamentally shifted the whole narrative around falling prices.
I think so too.
The central insight we've really uncovered is that the modern visceral fear of deflation, the thing that dictates so much of global central bank policy, is largely a fixation on that one ugly outlier,
The Great Contraction.
instead of the historical norm, which was good, productive deflation.
We've established that the historical norm was this wave of alternating inflation and deflation, often driven by massive innovations like railroads. And those periods were associated with strong, real growth.
And the key differentiator was always financial stability.
Always. When there was no banking crisis, deflation was overwhelmingly benign. 93% benign.
So if we accept that AI and renewables can make things, 900 times cheaper than mineral water, the analogy for central banks is pretty clear.
What is it?
They are essentially choosing to fight concrete, immense welfare gains from technology just to maintain an abstract psychological safety buffer of a positive price target.
The future demands a policy framework that embraces the desirability of price decline from productivity. Maybe something like price level targeting.
While at the same time fiercely guarding against financial instability with strict prudential frameworks, the financial system should be the shock absorber, not the amplifier of price changes.
Exactly.
So let's leave you with this final provocative thought to mull over, especially as you watch productivity data and central bank statements in the coming months.
Okay.
If we accept the historical lesson that moderate, steady-state deflation is actually welfare-enhancing, especially after you account for the fact that inflation stats are biased upwards,
And what?
what stream of long-term economic benefits, what real wealth are we currently giving up by unnecessarily targeting 2%?
And the mic drop quote from the research really reinforces that. It says, to an observer looking at the long history, current concerns about deflation may seem to be somewhat overblown.
We have to remember that our current low inflation world is, in many ways, structurally more similar to the high productivity pre-1914 past than it is to the high inflation 1970s.
The challenge isn't to run away from low prices. The challenge is to trust the structural strength of our economy, move towards a regime like price level targeting to anchor stability, and finally allow ourselves to reap the full rewards of technological advancement.